Hello and welcome to Weekend Investing Daily Bytes. We are shooting episode 326 today, 4th of January. And we are seeing that the US markets have gone for their biggest loss in the last almost 15 years. And is that good for India? So we will discuss that in today's episode. But today's data, you can see every sector in the market is red. Pharma, FMCG, autos consumption being hit the least, and metals, real estate, PSU banks, commodities, energy, and public sector enterprises getting hit the most. The market seems to have bounced from that 7 8 days before bottom, and now maybe that continuation on the downside has started. We've seen some losses in the US markets on the previous session, and there generally seems to be no pickup in the FII buying, although the domestic buying is still there. So there is a sort of a lull after this bounce, whether this bounce can hold, whether this bounce can go back. Uh, there is a bit of a confusion there. So the market remaining down for most part of the day started down, and then there was a bounce in mid of the day, but then it gave back all in. Today, there has been some technical glitch at the small case platform, so the performance reports are not yet updated. They will be updated by late evening. We will update it on the Telegram channel. In today's heat map, you can see pretty much red all around. HDFC Bank coming out with good numbers, still down 2%. HDFC down 1.5%, State Bank down 1%, Reliance down 1.5%, ITC down one quarter percent. JSW Steel, Hindalco, Tata Steel, that have been robust in the last many days, hit badly between 2 to 4%. Tata Motors down 2%, Power Grid down 2%. So the selling seems to be, not restricted to any one sector, but an overall sell-off of the entire markets. However, there were pockets of green. Prism Johnson up nearly 8%. Fertilizer and chemical down in the last two sessions, bounced up plus 5%. Carborundum and New India Assurance up nearly 5%. APL Apollo also up 4.3%. These were the top gainers. In terms of losers, Zomato, Sham Metallics, JSW Steel, AB Capital, Nazara all losing between 4 and 4.5%. These were the top losers in the CNX 500 universe. These are the returns of S&P 500, the primary index in the US markets. This source is from Mr. Charlie Belillo, our favorite data analyst on Twitter. And you can see that 2022, the losses in the US markets have been 18.1%. If you see the last 2 decades, from 2002 till 2022, there were only one large fall in 2008 of 37%, after which there were continuous 9 years of gains before a small blip. Now, this has happened several times in the past where we've had 1 or 2 years of fall and then two very good years. 1 or 2 years of fall, 3 good years. 1 year of fall, two good years. 1 year of fall, 4 good years. One year of fall, 3 good years. So there seems to be, and as we have moved from 1920s to now, the falls seem to have been reducing in terms of the frequency of the falls. So you can see in this period 1928 to 1946, there were many years where the market was falling. In 47 to 65, it was mostly green, only three small down years. 66 to 84 was again a challenging 18-year period where you had many, many years of large falls. 85 to 2003, virtually no fall for the first 15 years, and then the dot com bust happened here. and then here the great financial crisis. But in this entire 18 years, you had only one major fall here, and the fall now. So there is some sense that once we get over this fall, maybe in 23 or maybe by 24, there will be a long runway of some good years ahead of us. So a market fall should be seen as a oncoming opportunity. Either we can sit and cry about the stocks that have fallen, that may have been in our portfolio, or we can be optimistic about the high probability that the next few years may be extremely good, as the history tells us. And the good part about this setup is that India has not fallen. So there is a chance that US market bottoms out in the next 3, 6, 9 months. India does not fall, and then the global sentiment overall gets boosted up, and we sort of go from there on higher. So we may avoid a huge fall that has been happening in conjunction with the global markets that we have not seen so far. So that may actually make us leapfrog into the next cycle and avoid a major fall in the local market. But this is just conjecture and speculation at my end. But this is what something that we can get hope from. This is another chart from Charlie about all-time highs. So how many times has the index hit all-time highs in a particular year? And you can see that once you hit a year where you've hit no all-time highs, there is a series of years, where the market keeps going down till you hit a new all-time high. There are, of course, instances where it happens in the second year also, but there are many instances where the once the fall starts, the bear market starts, it takes several years to go there. So we are still at not in the zero mark here, but in 2023, if the market does not recover to an all time high, we may fall into some sort of a range of this nature, where we go into a slumber on the US markets. So these are some insights about the global markets. Of course, the global markets will cause some headwinds for our markets also. But the way Indian market has been setting up, the way the manufacturing PMI data has come, the way we have avoided falling with the global markets, the way liquidity of domestic investors has been flowing in, there may be a chance that we avoid going down with the global markets in 2023. Now, comparing S&P 500 with Nifty index, as I've been saying, that Nifty has held through. Nifty has been up 5% this year, while S&P is down almost 20%. So there is a huge outperformance that we are seeing of Nifty versus the S&P 500. And if we just concentrate now on the domestic front, after this 38% fall in the COVID times in March 2020, we saw a huge 148% gain. A lot of people could not participate in this rally because once we were here, the world looked like coming to an end, and people sold off here, or while it was coming up, people sold off here. And then when this was happening, this was sort of a region of not able to believe that the market can go up, and then it kept creeping up till we reached that point in October 21. And after this 145% huge run out of nowhere, virtually, a lot of liquidity came into the markets in the last 3 4 months of this run, and the market has been digesting those gains since then. So it has been almost 5 quarters, and the market is not giving up the level that it reached but it is digesting those gains and giving a time correction to this. So while there was a near 20% fall here, but it has been fully recovered, and we are basically jiggling in this 18,800, 16,000 odd range. And once headwinds from overseas markets do, get cleared at some point, 3 months, 6 months, 9 months, I don't know when, this range will get broken and we'll go ballistic upwards. That is one, major possibility that I see, unless we break down before that, and our own strengths that we are seeing today of domestic liquidity flow and the robust numbers that we are seeing in our economy, unless those goes bust in the meanwhile, I think this is very good preparation for the next launch going ahead. And I'll show you how this works over time. This is the Nifty chart over 32 years. If you look at this chart, you would say to yourself, why am I fearing the markets? At any point of time, I could have got into the market and made money just by sitting on Nifty. Nifty is giving you 12% CAGR for the last 3 decades. And even 12% CAGR with inflation being on an average between 6 and 8% is fantastic. I mean, you're beating the inflation by 400 basis points. You can create huge wealth just by 12% CAGR. You don't need very high numbers to do that. Of course, you have to bear this kind of volatility that happened in 2020 and in 2008. But overall, the trend remains congruently up, and there is no really a reason to fear the Indian market right now. In terms of weekend investing strategies, I want to showcase the results of the last 6 7 years that we've been running it, and I want you to see a pattern there. The pattern is that the returns are lumpy, and there are years of lull after that. So for instance, NNF 10, 16, 17, you had 51% gains. 17, 18 was 15%, you know a- as as per expectation. I would say then there were 2 years of negative returns. Most people would have thrown away their position, given up the strategy, uh, you know, gotten out of equity markets in those 2 years. And then there was a boom year of 50% again. Then there was a boom year of 36.9% again. So you have to stick on to your strategy for 3, 4, 5 years to really get that kicker. Evergreen 25.6% in 17, then 3 years of nothingness, then boom, 64% in 1 year, 42.7% in the next year. Nifty also doing similar, high double digit returns, then two years of average returns, one sharp down year, and then boom, 71% in the next 1 year. So you have to bear this painful years to get the upside in the markets. Same in mid and small caps. Mid and small cap 23%, 58%, minus 16, minus 21, plus 144, plus 44. MI 50, 54%, 23%, two negative years, minus 11, minus 2%, plus 97%. So the kind of gains that you will make every 3, 4, 5 years in that one lumpy year will only come when you stick to the strategy, when you stay long term with the strategy, when you stay true with your whatever you are pursuing. MI 25, MI 35, similar things. All cap strategies, again, very, very similar outcomes of fantastic returns once you have borne through couple of years of just going nowhere. And FY23 is turning out to be some sort of a nowhere year, where I think at best another year may go like this, but the year after that will give you a boom year. That is the high probability situation that is setting up today. So with this, I think US being down so much, and tech stocks being down so much, are actually bearing good fortune for Indian markets in the coming years. because the lot of damage that has already been done has not impacted us. And maybe there will be more damage there, and we may get impacted a little bit, but we have sustained that damage to a large extent, and that is very good. So with this insight, I want to end today's daily bite. Thank you so much for your time. Please do share these videos with your friends and family, and I will see you in another video. Bye.